Okay, thank you everyone for coming to Chapter 2 for financial accounting, which is analyzing transactions. Today we'll be going over the characteristics of a account and the chart of accounts for a business, which is the specific accounts a business has. And, for example, if it's service revenue, if it's fees earned, if it's sales commissions, each business is going to have different accounts for the different kinds of transactions that they personally have. So the names are going to be different, but the concepts are still the same for accounting for each type of business. Describing and illustrating journal entries using the double entry accounting system. This is debits and credits using journal entries. This is the meat of what financial accounting is and how the process is done. The financial statements that we went over last week are the end result, but the double entry journal entries is how we record all of our transactions as they go. And that builds on the accounting equation. And then journalizing and posting the journal entries to the chart of accounts, which is totaling up all the transactions. And preparing an unadjusted trial balance, which lists the ending balances at the end of the period of all of the accounts. And preparing using a horizontal analysis to evaluate a company's performance and financial condition, which is more to do with ratios and analyzing how is the health of this business and things like that. So we'll talk a little bit about the accounts of a business, what they're used for. Accounting in general is designed to show the details of business transactions, and that ends up being the increases and decreases to each account or part of the accounting equation in a separate record. And so we have to have enough detail to show information about the transaction just by looking at the list of accounts and what happens to each account over the period. And so each separate element is called an account. It has a title of the account and a space for recording increases and decreases. And in your accounting software, it'll also have an account number. But that's not as important here. But it's we have a whole bunch of records for a whole bunch of different transactions of service revenue, right? And cash and accounts receivable and accounts payable. And we have to group those transactions into what does it actually affect, and then group that further up to assets, liabilities, owner's equity, revenue, expenses. And accounts help us organize that. So for Net Solutions example we went over last week, cash, supplies, land would all be accounts, and then all of the amounts that impacted it are each transactions within the account, right? And each account has a title, and so, fees earned, wages expense, rent expense, those would all be accounts. And when we use accounts to record a transaction, we have these things called T accounts. And so we have the title of the account, then the left side and the right side. And so this gets into what is a debit, what is a credit. And all it means, this does not have anything to do with debit cards or credit cards. That's what I thought when I first heard this in financial accounting. It just means left side or right side of a T account and of the accounting equation. So the left side is a debit and the right side is a credit. For example, if we have cash, the the left side, and see, my right and left are not that's not my strongest skill, is saying right or left. So bear with me on that if I'm talking nonsense, okay? But the left side is a debit, and the left side is also an increase to cash. So the initial funding of the business, for example, $25,000, that's an increase to cash, that's going to be a debit. Because cash is on the left side of the accounting equation, because it's an asset, right? So you have assets, and then on the other side, you have liabilities and owner's equity, but a decrease to cash is on the right side, which is a credit. But, and we'll go over that in further detail here, but this is what a T account looks like. So debits, credits, and then at the bottom, we have a total. And because debits are more than credits, the total is on the debit side. So we have our rules. Increases in assets are recorded as a debit, and that is because they are on the left side. Decreases in assets are on the right side, because that's the opposite of the increase. And then see, this is explaining it in sort of a poor way, but right, because so the 5,900, that's going to be the total, and that's the ending balance of the cash account, which is a debit balance, because debits are more than credits. Also, we're going to talk about something called the natural balance of an account. Assets, including cash, have a natural debit balance. And why would that be? It's because generally, we're not going to have negative cash in a bank account. It's possible if the business overdrew the account, or if it's a special type of account that has a negative balance. But generally, right, things like cash, assets, like land or property, like they're going to have a positive value. They're on the left side of the accounting equation. Therefore, they're going to have a natural debit balance. A liability is going to have a natural credit balance because it's on the right side of the accounting equation. And so accounts payable, for example, would have a natural credit balance, because if you would expect accounts payable to be more than zero. And if you have a negative accounts payable, like that just doesn't make sense, right? A negative accounts payable would mean that somebody owes you money, but a payable is you owe them money, right? So it just doesn't logically make sense. So it has a natural credit balance, accounts payable, because it's on the right side of the accounting equation. So there will be some fill in the blank stuff on the homework, like saying, does this have a natural credit or debit balance? And we'll be able to identify that. And then to add up to get to the bottom, right, you add up all your debits, you subtract your credits, and then you get the balance of cash at the end of the period of 5,900, because, and you would put that as a balance at the bottom of your T account as a debit. So the chart of accounts for a business is the list of all of the different accounts that a business has. They're listed generally in the order that they appear on the financial statements. So assets, then liabilities, then owner's equity, then revenues, and then expenses. And the general ledger can refer to either a list of all the T accounts of a business, or the list of all the journal entries of a business. For the purposes of this textbook, the general journal is a list of all the journal entries, and the general ledger is the list of all the T accounts and then all the details within all the T accounts. So it lists out the transactions in each account over the period. And each business will have a different chart of accounts, right? Because the purpose of it is to track what a business does, and each business does different thing. For example, Anoka Ramsey would have accounts like tuition earned, and then expenses like, utilities expense, salaries expense, expense for purchasing textbooks, and then textbook revenue and things like that. Where, McDonald's would have an expense for purchasing the food and cost of goods sold and, expenses for developing their mobile app and things like that. So, and then revenues would be, they'd probably have an account for each type of revenue that they had for each of the different food items or something, or each of the different menu categories. The chart of accounts can also include, how does it subtotal up, right? Because if you have, and this isn't going to be on like the homework or anything, but if you have a whole bunch of different types of revenue, and then they all subtotal up into another line item of revenue that's for a particular factory or a particular business line, that could be in the chart of accounts as like a system of subtotaling to get, right? Like, so if you have revenues for all these different products that all come from a certain factory, and then they subtotal up into factory revenue from this factory, that could be included in the software for the chart of accounts. And then you have all these other products from another factory, and it subtotals to that factory. And that's kind of included in the whole chart of accounts concept, but the chart of accounts, it's just a list of all the accounts of the business. And right, you have assets, liabilities, owner's equity, which owner's equity also includes the dividends drawing account, owner withdrawals, things like that, and then revenues and expenses. So, for example, balance sheet accounts, they all go in order. One account that I don't think we've talked about yet in detail is unearned revenue or deferred revenue or unearned rent. This is what's called it is a liability of the business, right? So for example, if you are a landlord and you receive rent 3 months in advance or a year in advance for a building or a house, you haven't earned that revenue yet. You still owe the tenant a year of housing or office space, right? And we have to record the revenue under the revenue recognition principle in the period that it's earned. So that is a liability because you owe that service to your customer, and that has to be recorded, right, as such. So the accounting equation for that, right, would be an increase in the liability of unearned rent and then an increase in cash because you received cash in advance. And then as you earn it, you would decrease the liability and increase your revenue, which are both on the right side of the accounting equation. Which of the following would be an asset? Yep, factory. I think I heard factory. Right, because it's going to provide benefit in the future. We don't have to go over each one of these because I do want to get into more of the details of journal entries, but this is the one, right? This is related to the deferred revenue concept, air traffic liability. That's also deferred revenue. That's a huge item on airlines' balance sheets because they all pay when you pay for an airline ticket ahead of time when you buy it. Sometimes it's months in advance, sometimes it's pretty soon, but generally airlines have billions of dollars in cash that they've received from customers, but they still owe that customer a plane ride to wherever they need to go. So that does show up as a liability until they fly the customer there, and then they would earn the revenue. And so there is a transaction when the customer pays to create that liability, and there's a transaction when the customer flies to record that revenue. And the same goes for airline miles, right? If you have it's like a customer loyalty program where you fly so much or you pay with points you get points for a credit card and you get airline miles. Well, those airline miles are worth something to the customer, and the airline then owes the customer a plane ride eventually when they redeem those miles. So that all goes into the whole deferred revenue, unearned revenue category. And the exact name is going to depend on the problem. And so that name will be somewhere in the details of the problem. Like it will, there'll be the account labels and descriptions, or it'll say somewhere in the word problem, like what is it supposed to be called? And see that, so that frequent flyer miles, that's also a liability. Businesses use what is called the double entry accounting system. So we talked about this before, but it's based on the accounting equation and the debits and credits. And, because in the accounting equation, assets have to equal liabilities plus owner's equity, the left side has to equal the right side. Debits have to equal credits. If you are writing a journal entry, like debits must equal credits. That is 100% the rule. You can't let things get out of balance. So assets are on the left side. So an increase for an asset is a debit. A decrease for an asset is a credit. And then the opposite goes for the other side of the accounting equation. So a debit decreases a liability, a credit increases a liability. Same for owner's equity accounts. And then, we have to take that logical jump, right, for revenues and expenses. Revenue, an increase to revenue is a credit. A decrease to revenue is a debit. And then expenses, an increase to an expense is a debit. And then a decrease would be a credit because of how they impact owner's equity. And then a dividend or an owner withdrawal, that would be a debit because it's decreasing owner's equity, right? So I think, did you guys like the formulas thing that I created last week? Is that useful? This would be something that would be on that for this week, right? You're gonna wanna have this somewhere while you're doing the homework. And that's why accounting homework, right? It's about doing it. It's about working with stuff like this and going through it, because as you do, it's just going to become second nature. Like, this is how it all works. This is what it means. And then, yeah, income statement account, debit is decreasing revenue, credit increases revenue. A debit increases the expense, a credit decreases the expense. And generally, assets and liabilities and owner's equity, they're going to have debits and credits on both sides quite often. Revenues and expenses, it's going to be an exception to the rule, basically, for there to be a credit for there to be a decrease to revenue or a decrease to an expense, unless it's the month-end close after the period where we summarize it all into retained earnings. to close out the books for the period, or if there's some sort of correction to decrease revenue or to decrease your expenses. But generally, these are things that only go up, right, during the period. You're not going to have a revenue transaction and then reduce the revenue unless was some mistake that's been made, right? So generally, but I'm not saying that that can't happen. I'm just saying that that's an exception to the rule generally, just so you guys know what to expect. Does anybody have any questions on the debit and credit rules? Great. Because this, I mean, this is what accounting, what accounting is, especially for financial accounting for this course, it's creating journal entries. So we're going to be going through a lot of examples today. And it's very foundational for all of the rest of the course. And then owner's drawing account, debit for increases, and that also includes dividends or withdrawals or drawings, whatever you're going to call it, and then credit for decreases. DALOR, dealer, that is a good acronym for you to remember. So on the left side, the debit side, we have dividends, expenses, assets, and then the right side, we have liabilities, owner's equity, revenues. That goes for, right, if it's on this side, its natural balance is a debit. That's what we'd expect it to be at the end of the period. Natural balance is a credit on the right side. And when you're increasing each of them, it's going to be on that side and be a debit or a credit. So increasing dividends, expenses, assets is going to be a debit. Increasing liabilities, owner's equity, revenues is going to be a credit. And then we'll go through an accounting problem and we'll have all of our T accounts. And at the end, we have to create an ending balance for all of our accounts. And so, right, assets will have the ending balance as a debit, liabilities as a credit, equity as a credit. And then the drawings will have an ending balance as a debit, expenses as a debit, revenues as a credit. And because, one side is increasing, the other side is decreasing, they cancel each other out, right? So if you have, all your increases to cash on your left side, and then a number of decreases to cash on the other side, you have to take your increases, yet minus your decreases, and then you have your ending balance. And these are all included in a journal, which is why our debit and credit entries are called journal entries. And they serve as a record of all the transactions and where they were recorded. And this is something like if you're working in bookkeeping, this is that's what people would be preparing as bookkeepers, like they make entries in QuickBooks. Those are journal entries, or they appear as journal entries. And then if you're working as a tax accountant, occasionally you'll get, depending on the size of the business, you'll get a general ledger and it'll show you the transactions of the business and how they occurred over the year. And you'll use that to determine what were the revenues, expenses, where did all the money go, things like that. And then as an auditor, getting a detailed listing of all the transactions is extremely important because you can look at all of them and then you can choose which transactions to test. And so not only is this is the primary record in the business of where the accounting information is stored. And so it's, we're going to learn how to create journal entries today, but also journal entries are used to understand the business for the users and preparers of other accounting information. So this is how a journal entry looks. Chris Clark deposited $25,000 in a bank account to fund Net Solutions as the business, the initial funding. So you're going to have a date for the transaction, a description, and then this is the description of the account, and then the posting reference, which is a further step in this problem, and then a debit and a credit. And the debit is always going to be on the left side, so you're going to have your whole list listed out, then debit on the left, credit on the right. The debit is always going to come first in the journal entry, and so you're going to have cash as your debit in this transaction because it's increasing, and then it's going to show as a debit, and then, well, yeah, cash increasing is a debit, right? That was our rule. And then the Chris Clark Capital is $25,000. That's going to be indented, and that's going to mirror the fact that the credit is on the right side, so it's sort of indented, right? So that's why it's indented a little bit to show that it's a credit. And sometimes journal entries for more complex transactions will involve multiple accounts. Some will be debits, some will be credits, and so anything that's a debit will not be indented, and then anything that's a credit will be indented. And then you'll have debit, credit. Posting reference is when you take the transaction to your T account, you want to label it so that, especially on like a homework on a paper exam or something, right? You know that you got all of your, you know that you posted all of your transactions from the general ledger to your T accounts. And so you like label the transactions. This was transaction 1. And then when you look at your T account and you see this random increase to cash for $25,000 and there's a 1 next to it, you know where on the general ledger to look to find the details for that transaction. So it's just numbering of transactions. In a business general ledger, transactions will have transaction numbers so that you can look back and say, okay, cash increased $25,000 and you're auditing cash or something and you're like, well, why? What was the reason? What was this credited to? What was this debited to? And you can see the other details of that transaction and have a transaction number, and it's linked to all the other documents of the company. So it's for record keeping purposes. Right, so we have the date, we have the title of the account to be, we already went over all this stuff. This is just a lot of words to go over. So this will be in the details for the slides later if you need them. But we have our date, the title, the amounts of debits and credits, you can have a description, a little note for the account, right? So this transaction was invested cash in the business. And then the posting reference, which is later when you post it to your T account so you can track all the accounts that you did. Transaction terminology. This is important. This is for when you're in the homework and it has the short little word problem for a transaction. This is how to understand what it actually means, because there are very specific words that mean very specific things to pay attention to. For example, received cash for services provided, that would be cash and revenue, whether it's fees earned or another revenue account. Provided services on account, that means they didn't receive cash. That means it was an accounts receivable. So that's very important because you need to know what account to debit, because it would be cash or accounts receivable. Received cash on account would mean that a customer paid for a previous accounts receivable revenue transaction. So you would increase your cash and decrease your accounts receivable because your customer paid their bill. Purchased on account is the opposite. So your accounts payable would go up. That's a credit. And then the asset that goes up would be whatever asset that you purchased, whether it's inventory or equipment or anything. Paid on account is paying the bill that you previously accrued, and then paying cash, paid cash for, like, so it would say paid cash for land. Land would be the debit, cash would be the credit. If you said paid cash for haircut for your CEO, I don't know, he's a model, that would be the haircut expense and then cash, right? Owner invested, owner withdrew. So these are all the keywords that you need to know. So purchased land, Net Solutions paid $20,000 for the purchase of land. So cash would be our credit, right? Because cash decreased, and then land would be the increasing asset, which is our debit. And then in our T account, we have land with 20,000 on the left and then cash with it on the right because of our increase and decrease. Purchase supplies on account. That means that it's going to be an accounts payable. So we have a debit to supplies and a credit to accounts payable because they're both increasing. And then we have it on the left and on the right accordingly for supplies and accounts payable in our T accounts because that's where it lies on the accounting equation. For Net Solutions received cash for services provided. So cash would be the debit because cash is going up, and then it would be on the left side. And then on the right side of the T account and also the credit would be the 7,500 for the fees earned because the revenue is going up. That's an owner's equity account that makes owner's equity go up, so that's a credit. And then this is an example of how a journal entry can have many accounts involved in the same journal entry. So right for it, we have all of these expenses that we paid cash for. Well, expenses have a natural debit balance. They're going up. So they're all going to have their debits on the left side and all the debits on the left side of the journal entry. And then they're all not going to be indented. All of the expenses will be listed out. And then cash as a single entry on the right and indented. And then Net Solutions paid creditors on account. So that would involve cash because it says paid. Cash is going down, so cash is going to be a credit. So cash is on the right. The decrease is on the right. The decrease to accounts payable is on the left because it's a liability. And then our journal entry would have accounts payable as the debit, cash as the credit. For adjusting the amount of supplies we have on hand at the end of the period, supplies has our debit of 800, and then supplies expense is the debit, supplies, the asset is the credit because we're reducing the amount of supplies we have on hand. And then a drawing account, Chris Clark withdrew or drawings of $2,000 is a debit, and then the reduction in cash is the credit. We can go through each of these, right? But assets have a increase as a debit, decrease as a credit. We've already kind of, I think, beating the dead horse on this. Right, so on these, it's which of these are likely to have debits, credits, or debits and credits. Accounts payable will have debits and credits all the time, right? Because there's always bills that get accrued, bills that get paid, bills accrued, bills paid, and assets and like all the balance sheet accounts generally will have both sides, right? But as we talked about earlier, the exception is fees earned. Generally, you're not going to have a revenue and then have to walk back, reduce that revenue later, unless there was some kind of mistake, right? You already earned that money. And then expenses, generally, you're not going to reverse those because I mean, you're not going to reduce your expenses after the fact. That just doesn't make a lot of sense. Drawings, you're generally only going to have debits because that you're not going to, if an owner withdraws money from a business and then puts it back in, if they put it back in, that's just going to be an addition to the capital account. That's not going to reduce the dividends that were paid. And you know, utilities expense, right? You're not going to reduce your expenses. Now, unless there's some kind of mistake. And so we will go over later in this chapter, probably on Thursday, about how to correct mistakes. There'll be a few questions that say, there was this mistake. Prepare a journal entry to reverse the mistake. And then, right, these would not apply because there has been a mistake. You are reversing the mistake that happened. Now, the normal balance of accounts. What will be the normal balance of an accounts payable? Debit or credit? Credit, right? And then accounts receivable, debit, cash, debit, capital, drawing, debit, right? And then fees earned, credit, land, debit, rent, yep, debit, and then supplies via debit, and utilities expense, debit. Exactly. Does anyone have any questions on the debit and credit process so far? Cool. So we're going to go over each of these transactions and just sort of go over what the journal entry is going to be for each of them. For rent paid for the month of, so paid rent for the month, $3,000. That would be a debit to rent expense, credit to cash, right? And so we have our date, the title for each account, and then debit and credit. Paid advertising expense would be advertising expense and then cash. Paid cash for supplies. This is another one that's going to reduce cash and it's going to increase supplies for the same amount. So supplies is our debit, cash is our credit. Purchased office equipment on account. So that means it's going to be an accounts payable. The accounts payable going up is a credit, and then the asset going up is a debit for the equipment. For received cash from a customer on account, that's going to increase the cash and then decrease the accounts receivable because they no longer are owed that accounts receivable by the customer. And so then the AR, and then accounts receivable can be abbreviated as AR, and then accounts payable as AP. That's just a heads up on that. But yeah, cash would be the debit, AR would be the credit. And then paying the creditor on account, accounts payable would be the debit, and then cash would be the credit. Notice the on account. The on account is the main keyword there to look out for. Paid cash for miscellaneous expense. right? So cash is going to decrease, and then miscellaneous expense is going to increase, and so that would be our debit, cash would be the credit. Utilities expense would go up, so that's a debit, and then cash going down is a credit. And then for fees earned and billed for the month, billed to customers, that's the key word in this question. Fees earned and billed to customers. There's no mention of the customers paying for these services. So the customers have not paid. You can assume that. And then it would be an accounts receivable transaction. And that would go up. That would be the debit. And then the fees earned revenue, that would be the credit. Utilities expense. Um, you know, it says paid utilities expense. So you can assume that cash was involved, Laura?
Obviously, we have like paid that happen, but then versus like, like you said, the billing, it doesn't need it.
Yeah. Um, on account is the key one. I know there was a slide here. And this is a lot of the key terminology. It's not comprehensive, right? There could be other terminology, but this is generally, on account or paid cash. Those are going to be pretty clear indicators for those. In owner invested or owner withdrew, that's going to be owners investing or withdrawing. Um, you know, it's the key is to look um kind of and just think about the transaction and think, was cash paid for this transaction? And they try to make it pretty obvious, but if you're not thinking about it, it could slip by, right? So, for fees earned and billed to, there's no mention of the cash being paid. So when you're looking at a revenue transaction or an expense transaction, just try and consider, like, has this been paid or not? And you'll go over enough examples in the homework that you'll get used to a lot of the terminology. I don't have any other specific things that come to mind, but I'll try to bring them up as they come up in the lecture or the homework. They both are trying to trick you, but they also aren't. They do try to be fairly consistent in like how things are displayed and worded exactly. What was the final one? Oh, and then paid Mr. Faust for cash for personal use. So that should be something fishy, right? When you're looking at a transaction, it's like, okay, well, is this somebody's salary or is this the owner of the business? And then if you look in the description at the top, it says that this is, um, you know, BJ Faust Drawings is an account of the business. So you can assume that Mr. Faust is the owner of the business. And when the owner withdraws cash for personal use, that's an owner drawing. And so then the drawing would be the debit and the credit would be the cash. So as of January 1st, Shane Gerber Capital had a credit balance of 314,000. During the year, the withdrawals were 10,000, and then the net loss was $320,000. What is the balance of Shane Gerber Capital at the end of the year? Assuming that there have been no recording errors, will the balance sheet be prepared at 12/31 balance? So it started with a credit balance of 314,000. The withdrawals, are they going to be a debit or a credit? Debit, exactly. And the debit is going to reduce the 314. So we're going to have 314 so if we have capital, and I know this is capital as a whole isn't going to be the T account. There's going to be a T account for all these individual things, right? But if we're visualizing this as debits and credits, 314 starting as a credit. We have our debits of 10,000. And then net loss of 320,000. That's going to be another debit. Clearly, we have more losses than we have gains. Than we even had initial money in this. And so owner's equity, assuming there have been no recording errors, the equity in the business would be negative. I don't know if this means that the business is bankrupt or not. There could be other circumstances. Or there also could be other there's a negative equity balance of 16,000 in this business. I personally don't know where this negative equity balance would be made up. There could be another equity balance in the business. There could be but the liabilities of the business exceed the assets of the business. Essentially, that's what it means. So likely they had to take on debt to make up this reduction in capital, right? So then let's say that at the beginning of the year, they had maybe $1 million in assets, and then liabilities would have been something around 600, high 600,000s, right? And then that would mean liabilities of 600 something plus 314, that would equal $1 million. Now at the end of the year, they've had all these losses. Assets could be something like 500,000, and then liabilities are like 516,000. And then you have this 16,000 as a debit balance in equity. That's the negative equity, right? It is possible for a business to have negative equity in the business. So that's the key point here. And also that owner's equity and other general natural credit accounts, they can have a negative balance, right? So in this scenario, if you had assets of 500,000 and then the liabilities, this is a terrible marker, but if your liabilities are 516 and then your equity is negative 16, right? It's going to equal. The accounting equation is still in balance here. And that's the point of this exercise. I'll erase the other part later. So once we have our whole list of transactions, we can create something like this, which is a list of all the T accounts, and that's the general ledger of the business. And each one will have a little number next to it indicating what journal entry that it came from. So you can reference back, make sure that you've gotten all the journal entries when you're preparing this, and also trace what the details of the transaction was. And, looking at a transaction, you can also kind of assume what was the details. So for number one, cash was 50,000 of debit, and then capital was 50,000 of credit. So that was funding the business, increase to asset, increase to owner's equity. For number three, we had a decrease to cash of 10,000 and then a decrease to accounts payable of 20,000. Number two was decrease to cash 4,000 and then supplies increased by 4,000. Right, and so each of the transactions will get posted in a T account like this. And you can find detail, you can know what the transaction was by looking at how did this all affect itself. Based upon the T accounts exercise, before recreate the 9 journal entries from which the postings were made, the journal entry, you don't need to have the explanation, right? Because that you can't figure out that, but you can know what the journal entry was, right? So for transaction 1, we had a debit to cash. So we'd have cash and then we would have capital, right? So you'd have cash on your left, indented, you'd have capital, and then cash, debit, owner's equity, credit. And it would look right like that. Supplies, you would have that as your debit, cash is your credit. And you have to make sure to have the indent. That should naturally show up in Cengage, but if there's issues with how that all formats, please talk to me or Stuart. I don't want Cengage to be getting in the way of learning, right? Like that's not the whole point. The whole point is that the homework is supposed to help you guys all learn how debits and credits work. Equipment. So this is equipment is the $30,000, and then that's a debit, accounts payable, and cash. There's 2 parts to this transaction because they paid the $10,000 down, and then they agreed to pay the $20,000 as an accounts payable. So that's generally within a month or two, but generally within a month, really. But you would split that up. And so since these are both the credit accounts, they would both be indented because they're both credits for this transaction. Equipment is the debit. Operating expense would be the debit. Cash would be the credit for this transaction, right? And then it gets posted where number 4, 6,175, and then operating expenses, 6,175. This is a accrued revenue on account, so accounts receivable and service revenue. And then purchasing, no, this would be paying back accounts receivable, reducing your accounts payable with a debit. I said accounts receivable. This would be reducing your accounts payable. Accounts payable is your debit, cash is your credit, but right, you can see, accounts, right? Accounts payable, number 6 transaction, it's on the left side. You can recreate this by putting the debit is a left side transaction. So you have accounts payable is your debit, it's on the left side. Cash is your credit, it's on the right side. The number 6 transaction has the $6,000 on the right side of the T account. And then, receiving cash for the accounts receivable. And then operating expenses. This is the end of the month supplies correction. So reducing the supplies with a credit. And so then that goes down to your credit. And then the expense debit goes to the debit in the journal entry. And then the drawing account can find where was the drawing account. It's all the way up there, the 9. And then that goes to our debit here. And then the cash goes to our credit over there. And then it was a withdrawal by Ted of cash. Does anyone have any questions on T accounts and posting the journal entries? Cool. So a transaction is first recorded as a journal entry, and then the journal entries are periodically posted to the general ledger, which is the list of all the accounts. And that process is called posting. You'll have your numbers, which are the transaction numbers for the account. And T accounts are useful for instruction purposes, like showing how it's all listed out for this. But for how a detailed listing of the revenue ledger would look for a business, is it would just be a huge spreadsheet. And then at the end, it would have a negative balance for a credit or a positive balance for a debit. And then all the columns in your Excel spreadsheet would just say like the details of the transaction. And if it's your revenue ledger, it would be all the revenue transactions, but it wouldn't have what the other side of the transaction was, whether it was cash or accounts receivable, because it's just a detailed listing of all your revenue transactions. Businesses are going to use that for their own personal record keeping tasks, like looking at what the revenue was at the end of the month, or auditing revenue, or preparing stuff for their auditors. And it'll have the 4-column account has date, item, posting reference, and then amount, and positive or negative would indicate a debit or credit. That's how it would appear in an actual business. For the purpose of the instruction, it's much more useful to list everything out in a simple manner, not have all those columns, right? Because a machine's not making it, you guys are. And you can see the whole chart of accounts all at once. I think that's a pretty good stopping point for the day. We only have 3 minutes left. Is there any other questions or things you'd want me to go over today on the homework, on the quizzes?